Hello guys, Joe with Bitraged. So we got some questions on margin trading and what going short is, what going long is, what the difference is, how you would get stopped out, how you would get closed out, how a margin call works. So I wanted to answer some of those questions here in this video, clear some things up. Short selling is simply selling stock, or in this case Bitcoin or whatever coin that you're trading on margin, that you don't own. So what you're doing is, let's say you're trading on Bitfinex. You're borrowing Bitcoin from them to sell, to get cash to buy back in at a lower price, theoretically. So for example, let's say you saw this and you took a short position here. What you're doing is you're borrowing Bitcoin from the broker to sell at this price. Then you have the cash to buy back in at a lower price. You return the Bitcoin you borrowed to the broker, you keep the difference as profit. So in this case, if you took a position here, a short position, and wrote it to here, you would have made money. You would have been fine. And then you can return the Bitcoin, pocket the difference. But how you would get closed out, how you would get a margin call out of this situation is, let's say you took a position in here or up here. You took a short position here and then this here happens. So what you did is you borrowed Bitcoin from the broker to sell at whatever price here you got in. So let's say you got in here, took pretty good position here, but you didn't get out at the right time. You got in here, you sold that Bitcoin right here. Now you have cash to buy back in, but you didn't get out here. You didn't buy back in and return the Bitcoin. You thought, well, this is going to go lower. So you kept that position open. And then this spike happens. When this spike happens, that position gets taken out. Your position gets closed out and gets liquidated. So what happened is the broker says, you're too far over leveraged. You're too far overextended. We want you to close the trade and give us back our Bitcoin. So for Bitfinex, they have a 15% maintenance margin rule. So you have to have 15% collateral in your account. So let's say you took a $500 position. If you took a $500 position, you'd have to have $125 of collateral in your account to prevent forced liquidation. Now let's say you took a $500 position, your account was only worth $500, and this move happens here, there goes your account. There goes that position. Now, maybe it wouldn't wipe out your account, but you would suffer a serious loss from that. So that's how shorting works. A long is the opposite. So what you're doing is you're borrowing money or you're borrowing Bitcoin to sell at a higher price. So let's say you got in somewhere in here and you took a long down here. You borrowed Bitcoin with the obligation to sell at a higher price. So you either borrowed Bitcoin or money, it depends on what your broker does. But let's say you borrowed Bitcoin, now you're holding Bitcoin here, and the price goes up. You sell that Bitcoin, give back what you borrowed to the broker, you pocket the difference, you pocket the profit. If you took a long position here, you borrowed that Bitcoin, and the price went down, now you've got to buy in at a lower price, suffer that loss to satisfy the obligation of the broker so that they can have their Bitcoin back. So that's essentially how shorting and going long works. It's pretty simple, but you can see how you can get taken out very easily, especially in this market. A move like this or a move like this would definitely take you out of the business. It would take you out of the trade, and you'd lose quite a bit on this. That is, unless you were shorting from 11,000, 12,000, or a lot higher, then you're still in the trade. In the stock market, sometimes when there is a large interest in shorts on a particular stock, large investors and large traders who own that stock will notice that. They'll pump the price up, they'll drive the stock price up. This will force those with short positions to cover or buy back in those shares at a higher price, take that loss, and in some cases lose their account. because if the price goes up by a significant amount, they get taken out. Sometimes they go bankrupt. For example, in 1901, Northern Pacific Corner, which was a railroad, went from $170 a share to $1,000 a share in one day. This took out extremely wealthy guys with short positions. They went bankrupt because that position not only took out their trade, it took their account out. And so that's the danger, and that's how this can be used to manipulate and get the desired position. Because if you're a large investor and you own shares in a stock and there's a lot of short interest, you don't want the price to go down. So if you drive the price up, it forces those with short positions to cover or buy back in those shares, forcing the price to go up. And in some cases, you can get stopped out with a stop loss. Or if you didn't have a stop loss, you didn't really understand where to put it, or maybe you didn't want to put one because the market's so volatile anyways that you could get stopped out, and you don't want to get stopped out if the price is going to continue down. But if you look at this here, these are shorts. These are shorts getting taken out, right? So you see this move here, and then a break, and then this here. So what's essentially going on here is you've got some stop losses being triggered, and then you've got some liquidation happening. So you got some positions closing that weren't necessarily meant to be closed. These are people that didn't plan on their position closing. They didn't necessarily have a stop loss, or it wasn't close. And so those positions got liquidated, causing a huge drop in shorts, taking a lot of shorts out of the market, which takes all the sell pressure off the market and allows the price to move up. So what does that do for Bitcoin? What it does is it takes some of the pressure off the market to sell and allows the price to be moved up. So this market, because of the volume and because of how new it is, and it's not really that established, it's pretty easy for a large trader, a large investor, or a organization to drive prices up, forcing those shorts to get covered, allowing prices to move up higher. What's going on in the market here is a simple consolidation pattern, and normally, typically, in a normal market, price would exit the triangle the same way it entered. So if it entered in an uptrend, it would exit in an uptrend. That's normal, but this isn't typically normal conditions. So there are longs coming in, and they're starting to build up, but it's pretty low. Volume is pretty low, and at this point the potential for either direction is still possible. There's still the potential for it to exit either direction because of the condition of the market, because of volume, because of where we are with longs and shorts, and there's still that potential. And so you have to watch and see what happens, because frankly nobody knows for sure which way it's going to exit this triangle decidedly. And so that's what you've got to be aware of. But that's how shorts work. That's how margin trading works. That's why it's so dangerous, because you can get taken out and you can suffer huge losses. You can suffer losses larger than the account balance. And that is pretty hard to stomach for a lot of investors. So if you are margin trading, understand the risks. If you're not and you want to, understand that it is extremely risky. And if you're not a very good trader and you're not making money in the market and you're not making money just buying and selling, you're definitely not going to make money margin trading. You're going to lose money. So just be aware of that. But that's all I have for you today. If you're not subscribed, we'd appreciate you subscribing. Like the video if you liked it, and give us a comment. Let us know your thoughts. If you have a question, we'd be happy to answer that. Thanks for watching, guys. Take care.